Welcome back to Romberg and the Money, your weekly rambling stock market rundown where we, your hapless hosts, discuss current events and spread wild conjecture in an ever-shifting market. We are rank amateurs. Every word we say is the opposite of financial advice and should be completely disregarded. Romberg is not for everyone. Please consult with your financial advisor to see if you are healthy enough for Romberg. Whenever you're ready, Mr. Jim Howe.
Well, you should welcome me at least.
I'd like to welcome to the stage, the digital Skype stage, Mr. Jim Howe, from his bastion, his little private resort in Hawaii. Applause.
Yes, I want a laugh track.
Earned exclusively through his day trading antics, Jim has remarkable success, and you too can buy your own private island if you live in a delusion.
I totally live in a delusion, and I totally love being here in it. So I just want you to know.
Better than the real world.
The real world is. Yeah, I think I agree with that, man. I think I like my delusion better.
The real world is not putting up much of a fight these days.
I'm not going to get into the idea of consciousness and how it affects our world and how that maybe our attitude drives what our vision becomes.
You know what? We need two shows. We need one that's about stocks and one that's about metaphysics.
Oh, I'm totally into metaphysics, dude. Not in a crazy way, in a weird, bizarre way.
All metaphysics is in a crazy way.
I don't think it's.
And it's all perfectly sane, which is really the problem.
I know it, right? There's a lot of logic all structured into the system. It's like, it's so amazing. I mean, it's like entanglement, right?
Mm-hmm.
We're not going to go there, though.
Spooky action at a distance.
Yes. Different show.
Show, yeah.
Yeah.
Stay tuned for Romberg and the Science or something.
Romberg and the Science. So, it's been, I think, a very kind of weird week. The market started off this week kind of like, I don't know what I want to do. Maybe I'll go up, maybe I'll go down, maybe I'll stay up a little bit. But it was kind of like the I don't know what I want to do market this week.
Yep.
Until there was a little insightful day, I think maybe, that came on Monday or Tuesday. There was some movement, and then it kind of like, I don't know. It was kind of odd, and there was really not a lot going on to drive it, in my opinion.
Yeah, I didn't see any major headlines, but the stocks sure seemed eager to move, and they just didn't really know where or why. I mean, yeah. They knew why, I didn't.
Well, yeah, they have their own world. They live in their own world. They go where they want to go, right? Yep. So, remember we talked a while back about how the market, inflation was, oh my God, I'm worried about inflation. Oh my God, inflation. Growth stocks down, finance stocks up. Go get something else, And of course, now this last week, gold hits an all-time low.
Oh boy, howdy, am I glad that I had dipped on gold after I got my little return, picked up my dividend, and called it good.
Right, and wow. I'm like, okay, and then unemployment numbers came out and they were bad, and then everybody went, ooh, so maybe inflation's not so bad, right? So they all jump back into equities again, right?
How often are we getting employment numbers? Because I feel like we talk about this weekly.
We do get them often, and there was employment numbers, I think, this morning or last night, or I don't know, whatever. I live in Hawaii, so my sense of time is not exactly linear. But
you work on island time. It's real.
But I was listening to Mr. Biden yammering about the numbers, and the market reacted this time that the numbers were good. This is the fickle nature of news and market mood that I've mentioned before. It's like you can't know what the market will really do. If the preliminary context is I'm worried about inflation and you get bad employment numbers, everyone's happy. If inflation's not an issue anymore, then you're now worried about employment because it drives, consumption. So evidently we've decided that we're not going to worry about inflation for the moment, and now consumption's more important. So the good employment numbers that were reported today made the market happy.
Right.
So the market is what do you call that when you a Jekyll and Hyde almost? It's like I'm psychotic, and I can't tell you today where I'm going to be tomorrow because I don't really know yet until I wake up.
I think really what it is it's a fantastic entropy sink. Like if you wanted to make a random number generator, there is little you could use to be more effective than the stock market.
Probably.
It is a perfect source of just noise.
Right. Well, so I just want to, I'll just, we talk a lot and we talk too long sometimes, and I don't think really.
No, we don't talk too long. We talk the exact right amount every time. This is a well-oiled machine. We know what we're talking about at all times. There's an agenda. It's working out great.
So you'll see if you're on the YouTube version of this conversation,
yes.
My chart.
You'll see, we say to the people listening on podcast.
I have my chart up I decided that maybe I like to talk about the things I do. And since nobody really sends us any questions or asks us to talk about anything specific, I decided I'll talk about what I do and I like to do.
I think that's the right call regardless.
Well, it is all about me, right? In my metaphysical world of me painting the picture of my own future. So
you are the portrait that holds its own brush.
Exactly. So here's what I want to say. It's like I trade this all the time. I don't trade it in the context of a normal buy it and sell it operation, but I do buy and sell, basically sell put options, and I buy them back when it's appropriate.
Right. You in this case, you sell low, buy high.
Yes. I sort of.
No, you technically do. I think it's hilarious.
So what we're looking at is...
hold up. Sorry, real quick aside. This is what you should tell your brother to do, is just anytime he wants to buy a stock, he should buy a put. Anytime he wants to sell a stock, he should sell a put.
Oh, that would be perfect for him because he's always on the wrong side of every trade.
I feel bad. Like, I've never met the guy, and I'm sure he's doing fine, but it's a constant source of humor for me.
Well, I have another brother who does really well too. Actually does really well. He doesn't do what I do, but he has his own plan. And I think the most important part of the plan is the emotional disconnect from our money. I do this for the love of doing it, and I'm making money, and that's wonderful, and I like doing that, and it feels good. But I can't make money if I'm emotionally connected. I can't make it if I'm emotionally connected to it, because then I make emotional decisions out of fear and not out of thoughtful logic and thoughtful risk management.
Yeah. And like the day-to-day fluctuations can really like throw off your game plan. And if you're rethinking these things on a daily basis, it's easy to leave at the wrong time.
My brother, my number two brother who does this, calls me every time the market takes a swing down. He's like, "What are you doing, Jim?" And he says, I know what you're doing, Jim. You're starting to acquire again, aren't you? You're changing your positions up and taking advantage. And it's like, yeah, I am. Usually.
You're like, yes, obviously.
Yes, I mean
the stocks are on discount. I buy on sale. Right.
The idea of buying high or buying low and selling high, it can't function unless you actually buy low and sell high. You actually literally have to do it. But you can't buy high and sell low. That's a misnomer. It's impossible. But you can run the median across the middle of the screen there. You can get in the middle somewhere, and maybe I drop out here and I buy here and I drop out here, and then I sell there. I mean, it's kind of like I'm trying to buy and sell the middle line. That's what I'm doing. Buying and selling the middle average line over a long period of time. And one of the things I wanted to suggest, and because the TQQs, or as I've said earlier, I'm a tech trader. That's my favorite place to be, because they represent the top 100 NASDAQ companies in a triple leverage format. They still represent what the NASDAQ market looks like on a chart, right? So, and I want everyone to take notice, if you have the YouTube version of this,
yes,
that right here, right across there, is something worth note, because in this current time frame, which is 1 year, you can see that we have hit this peak, and we wandered off of the peak again back to the bottom of our channel, and then we started wandering back up again to that peak. And the key here is right, in the is that right here.
And what's the dollar value on that?
110-ish.
110-ish, okay.
Right. Is that, I mean, this is our second top, right? But right here, it broke this resistance line.
Right. So we see it breach there again.
Yeah. So that and not only did it breach that resistance, it continued to push up fairly strong. And when you're looking at
this is a great time to be able to look at volumes too and see, like, okay, this isn't being traded at a really low volume. Like, this is sustained by a good chunk of the market.
Yeah, I mean, there's a push in here. It's not a reversal trend volume like that line right down in here. You can see this down here. That's kind of a reversal. This is like mass selling followed by some buying and selling and then stabilizing, and off you went back up the other way again. So you can take, I think
it's called profit taking.
Yeah, well, yeah.
I think it's called panic selling.
So the weird thing about profit taking, people can do that if they want to, but here's the problem with profit taking. You miss out on gains. You can take a profit.
The people who are doing this aren't us. It's not you and I. It's the people who have enough money that they can drive the stock down, start the sell-off, and then buy it again in like 2 days.
Well, yeah. The problem is if it goes up in the 2 days, you sold at one value and bought in at a higher value and missed the gap.
The people I'm talking about don't do that.
Oh. Because that would be a bad plan.
Yeah.
Now, in the short haul, when we get up here and look at this in a 3-month window line, I mean, this gap, I fully, there's a theory about gaps on waves, and that space in between has to be filled with a trade somewhere.
Right.
So the market, I mean, what makes a technical analysis work is that people actually trade based on it. It's
it's so much of its belief. Like when you're looking at candlesticks, what makes it go up like a positive whatever, positive pattern is that everyone thinks it's a positive pattern, so they buy.
It's like a self-fulfilling prophecy.
It is precisely a self-fulfilling prophecy.
So there's a gap, and the theorem is the gap always gets filled. So next week, I expect that we're going to see this value decline at some point along the week to a number that's down in here, 122-ish.
Yeah, we need to see that change happen during day trading. It can't be an overnight thing.
Yeah, it's not necessarily going to last for any length of time. It just is going to happen somewhere along that time frame. So when you so next week, I'll leave this here for next week. I would expect next week to look, because this is going to sound crazy, but if you look at next, fully expect there to be a potential trading window given the force and momentum of the direction.
What's that? Right in the middle of your probability window? Crazy.
Well, it covers, technically the probability window drops all the way down.
Yeah, it
and
goes a
these
little bit lower.
probabilities, all these little tools I use have special settings, so they don't really necessarily work unless they work for your own purposes if they're designed in your settings to be what you're. So I have a program, I have a whole lot of rules that are set out. And so in my rule set, I decided that this probability window cone I like to use happens to be based on a probability of 60%. I'm not really interested. The higher you run these numbers, the broader the statistical
the less
window
useful
goes.
they are.
Right. So if I just said, let's say I want that to look like 50 days, and I only want to look at inputs from the last 7 days to get a perspective. I could also increase this to 9 days to get a different perspective, and it'll change the window, as you well seen here, as we just applied it. Now that window really would have to decline at a 50-50 range. I'd be looking at that at the top and somewhere in here at the bottom, 121. So it's a 50-50 proposition that the stock lands in that zone.
Just to clarify real quick here, it's a 50% inside, 50% outside, not a 50% up and 50% down, right?
No, 50% inside, yeah.
Got it.
So anyway, the next thing I want to mention while we're doing this, and I thought it would be a good idea, I want to just track this one week to week. And maybe there's people out there that trade this, and I'm going to leave these markers in place.
Okay.
So they can kind of see what it looks like and how it comes out. I don't hit them every time. I make mistakes. Sometimes I misread.
Right, but you can kind of see the general trend,
expecting.
like, okay, these are hitting more often than not, and here's why.
Right. So like right now, if I had bought this TQQ, if I had literally bought it, I would be down here with a trailing stop on it. I'd put it out there this way, ATR, and this is like $4. I'd probably have a $4 trailing stop. Now the downside is because it gapped up, it's going to come down, and it's probably going to come down that $4. But somewhere down here, I'd have my number picked that I would say, you know what, I don't know. If it comes down and breaks through the 120, the 117 marker, 118, then I'm looking at coming all the way back down to somewhere around 112. So there's a place in there
to
that
at least the median.
Yeah, if there's a place in there somewhere that if I literally owned the stock, I would not want to own the stock. I would be like, I don't know if I want to do that. Right. And now, if I'm going to be sitting in this stock for the next, my strategy says, I believe in all this. The fangs are going up.
You're holding it for the long haul.
Well, longer haul. At least if I'm holding it to the end of the year, I'm not really worried about it at all, unless it comes down here somewhere. And then it might be just an opportunity to buy it. But let's just say I'm going to use this so that we can measure what we can accomplish. And in that context, remember last week, I believe, we took up a position as an example. Mm-hmm. And our example was that
2 weeks ago, maybe, but sure. Or was it last week?
Well, I can tell you when it was. We bought a stock here on 6/28 trade time, 6/28. We sold a put on 100 shares of that stock, or one contract, for $117 strike,
Uh-huh.
117.50, and we received $19.90. We don't own the stock. We just sold somebody else the right to sell it to us.
Right. We
In
sold the put.
January of 22. And I chose the longer range because I wanted to show how that volatility can be mitigated. If I'd bought the stock, I would have made more money. If I had bought that 100 shares at 117.50, I would have made more money. I would have made, what's it trading for?
Right, but leverage.
Well, it wouldn't have mattered. It was 117.50. So, and today it's 127. I would have made $10 a share. I would have made $1,000 already.
Mm-hmm.
And the way this is set up, I'm going to make $2,000, roughly $1,990 by January. So when you look at, let me just add something here. Oops, that's not what I wanted. I can't. It doesn't work that way. There we go. Roar. There we go. Roar. In fact, I'll add roar, and then I'll add max covered. Okay. There we go.
Mm-hmm.
So you can see that the risk on my return, risk on return, is 17%. So
Okay.
theoretically, between now and January, I have potential of making 17% on that trade. As long as it keeps going above, as long as it stays over 117, I'm going to make that money.
Right.
Right? My maximum covered return doesn't apply in this case, so I guess that doesn't matter. But when you run that out, if you run that number out, if you're being conservative and trying to mitigate risk, that is 6 months. That's over 2.5% a month for 6 months. Well, okay, I am not greedy. It might double. It might go up. I could have made maybe $20,000 if I had bought that 100 shares and it went up 20 points. And that's wonderful. But what if it doesn't go up 20 points? Here's my risk. I sold it for 20 points at 117, right? So I'm not going to. I will make that 17% even if it goes down to $107.
Mm-hmm.
Or actually lower than that. About $99. As long as it stays above $99, I made 17%. And what's my risk? My risk has gone down enormously compared to physically owning it.
Right.
Because
yeah.
if I owned it at 117 and it dropped 10 points, right, then I'm losing
Right,
1,000.
the number of dollars is more.
Yeah. So
but the percent loss is higher. So, pros and cons.
Right. Well, gain and loss to me is not a thing. Because, I mean, it's a thing. I want to have gain. But I have a fairly solid probability, probably above 80 to 90%, or 80% at least. In fact, I can tell you what it is.
High. It's high.
All right. Out of the money. Out of the money for me would be meaning that the people that, because I'm selling it.
You keep the money.
Yeah. Out of the money, risk percentage is like a probability, right? That this will be out of the money. And so the inverse of this is in the money, which is about 93%. I mean, you don't need, I don't need to put it in here to see it, but it'd be about 93%.
Yeah, you can see the remainder.
So the probability is that I am going to keep that money. It's like above 90%. That the likelihood is that when this time runs out, I made that money. So why would anybody in their right mind not want to worry? I don't worry about whether it's going to go to the moon. I worry about what I have in my bank account on a return.
Jim, you're killing me, man. This is what I tell you every time I tell you that I'm selling calls. You're like, well, you're missing out on all that gain, and I'm like, I don't care.
Well, but the thing is, I'm not missing out on the gains. That's the point. By doing this, every time it goes up, the time value is going down, and the value that I sold that goes down. So I'm still making the gain too. I'm just not making as much gain. If I cap this out and sold a put or sold a call on this at 117.50, and I sold the call at 125. Well, a couple of days ago,
I get the difference. Money. I'm just saying the logic behind it is the same.
Not really.
Okay.
Are you selling? I mean, no. Well, let's play a game. I'll play a game with you. Let's do this. Let's go out here and look at. Let's go out to the same period of time. And I'm sorry, let's try to do that. Let's go out to January 22, and of course the 117 is off the table, but let's say 117. So 117 in January is worth $34. Right? I can sell 100 shares in a contract format as an option for one contract, and they would give me $3,400 for 117.50. The problem now is that that I'll get the money, but this stock is, and you have to know the stock. So this isn't just about the concept, it's about the stock. If you have a really low beta stock, and you can get some change up there, you're probably going to be okay, but you also don't get much money. So if I go out here and sold this option right here.
Right. I mean, that's what I'm saying is I'm selling them out of the money. Like,
I know.
Out of the money.
So how far out of the money do you want to go?
It depends on the stock. For ones that are really volatile, I go further. For ones that aren't that volatile, I come closer. What I'm really looking for is to add like a couple extra percent a year. Like I said, I'm not greedy. I just pick a number where like it's going to have to go up 20% for me to be washed out. And then I'm like, all right, well, I got 20% and my extra 1%, good game.
Most people, and I don't know, maybe you can. Actually, I don't even think I can do this. Most people can't sell a naked option.
No, I usually own 100 shares of it that I sell the calls against.
Or
I have a poor man's call where I own one and I sell another.
So let's at 140. Let's take a look at what that looks like. Sell a custom, and keep track on time, because I need to be kicked out of here. I'm a talker, and I just keep on traveling.
Well, we're 30 minutes in, so I figure I can give you another 5, and then we'll start wrapping up.
So if I go in here and go covered call, please, let's take a look at what that looks like. So if I sell a 140, and that's actually being, so if I sell a 140 out in January 22.
And what is it right now, 126?
126. But this stock can rise 16 points in 2 weeks.
I was going to say, that's only 10.5%. I would probably go further than that, but this is fine for our math.
All right, so now we open up the window. Let's take a look at what this is telling us. If I buy that with the covered call, my maximum Well, I gotta look at my quantity here because I might have this set too high. It's too high. Like we're gonna do one contract or easy math, one contract. There we go. We have one contract out here, and the break even on that contract is 102, right?
Uh-huh.
The maximum you can make is $10,000. So if you have a stock that's rising and volatile like this one, it would only take 10 points of upside before all of a sudden you have a limitation.
Right, because this one in particular, like you're not getting that much of a call, not that much of a premium, and
well, you're getting
it's
a
only
big
10%
premium.
out, so you go to 10.6% or whatever, and you're gone.
I beg to differ with you on the premium. You're getting a pretty decent premium.
Well, sorry, I'm saying like compared to the price,
Yeah.
and then just how likely you already get washed out.
So if you go, you could go further down the pike, but so these are all set for probability in the money probabilities, and so if you're running down the line, and you can take a look at these probabilities. What's the probability?
Yeah, like I'm looking at that call. I see like where's the one that's at 20%? I see one that's almost exactly 20%.
Over here on the call side.
Yeah, it's like the third from the bottom.
Yeah, this one, 20%.
Yeah, is that so? What's the premium on that?
The premium is only $1,450, but you're going to make let's do that.
That's probably more where I would be putting one if I was doing one right now.
All right.
And what's the strike price on that?
Buy. Strike price is 170.
170, and it's 126 something right now. 126.
So you buy covered, right? If you're
see, that would be a 35% increase in however long. So I would feel more comfortable with that.
Let me edit this real quick. I gotta get this default back. Change the default one of these days to 1. Whoa, what the hell is that? I only want 1. Oh, buy. Where's my buy? I should just do this, Jim. -1. There we go. All right, so what this would look like is it's a 170. That's 50 points, right?
Mm-hmm.
And for your 50 points, though, you're only getting $10 premium. So, and you have to own the stock to do it.
Yep.
Right? So your maximum profit on this deal is $5,000, which is basically on 100 shares, I guess $57. That'd be your maximum profit.
Mm-hmm.
And your break even is 112. So the downside of this kind of a trade is I had to buy 100 shares. The downside is 112.
So where I think the disconnect is I'm not talking about buying 100 shares to sell a call on it. Like I think that is a terrible strategy.
Well, that's your covered call strategy. That's what you got to do.
No, I'm talking about I'm buying these stocks anyway. I want them to work for me in the meantime. And so I'm buying these 100 shares, intending to keep them, putting this at such a high number that I'm either A, don't think it'll get there, or B, would be happy if it did. And then I get to keep that premium in the meantime. And like you said, there is the risk that it's going to blow past that. Like this is up 35%. If it goes over 35%, and what time frame is this again? Is it 6 months?
All the way to January 22.
So 6 months.
Yeah.
So if it goes up more than 35% in 6 months, I'm in trouble.
I'm
not even in trouble. I've gained 35% in 6 months. I have annihilated almost everyone else in the market. So
I got to call you out on this because buying in this analogy where we're buying it, we don't own it yet, but you're assuming you already own it and have gains on it to start with. But that's not, it's the same deal. You have to take a position to sell the position.
100%, but what I'm saying is here, I don't end the game after a single cycle. My intention is to do this every 6 months. So
You can, yeah, you can exactly, but
I have now bought this investment that I'm now using to make reliable income on it.
I think you're missing. Well, you're missing the boat. You might lose your reliable income, and that would be in the best opportunity. And the worst one is at 112 because you had to have an underlying stock to sell it for, and a break even at 112. In this case, for instance, if it goes down to 90, it doesn't matter how much money you took in. You only took in $1,000. You're still going to lose.
But that's, I mean,
$5,000 or
once again, I'm not talking. You'd be saying in that case that you'd have to sell that stock that you're long on.
No, I don't. You don't have to sell it.
Well, then you're going to be down at 90 as well, and you won't have gotten the money that I did.
No, I won't be because I wouldn't actually make this trade.
No, that's what I'm saying. Is like, okay, let's say
under these conditions.
I think you're missing what I'm saying here. I'm buying 100 stocks anyway. This is happening. Okay.
Well, I get that.
And so if I sell the call, like let's say we're both buying it. It's a stock you want, right?
Right.
If it drops to 90, you've lost that whole thing. There's no ameliorating factor here. Whereas
tell me a real stock that you are interested in.
I would do TQQQ. I've done it with TQQQ.
Okay, well, just give me an example of one that you own. I mean, I
own QQQM right now. I have a decent position in QQQM.
So, if you
this is not as much fun to do this with, mind you, because it's a lot more stable of a stock.
Well, that's my point. It doesn't matter because it only matters what the premium and the break-evens are. That's all that matters. So, if you take a stock like this and you go down here, so this is trading at 140 whatever 7, right?
These are for July, by the way. This is for 2 weeks from now.
So let me scan down here. I don't get January here, but let's go out the furthest we can go. So you have
so this is 5 months.
You have a $147 stock, right?
Mm-hmm.
Right.
Excuse me.
Roughly. Right. So if you go way down here,
for this one, let me just tell you how I do the math, and then we can run out exactly how I do this. So QQQM, I anticipate probably about 7% annually is a good ballpark. I would go at least double that, so I'd go to 14%, and then I'd be looking for whatever that, let's say 5 months. So let's call it 6 months. So I'd be looking at a minimum of up 10% before I would even consider doing this. So what are we at right now? We're at 147. Mm-hmm. Yep, so I'd be looking at 165 basically.
All right. So 165
on out.
So what's your return? 140. Right?
Yep.
You're going to get $140. What's the ratio? What's the return on that?
140 on what's the value? It's basically 1%, I think.
So, okay.
It's 1%.
Of the commit of okay, so you make 1%. In how long?
5 months.
And why would that be a good trade?
Because I'm getting 1% extra on a stock that I'm long.
Yeah.
Yes.
But you also risk that stock making it to 175 and then losing.
I run the risk
of getting
a spectacular couple
is it
months.
Is it worth $140 to risk losing a rising stock?
You can't guarantee that the stock's going to make it there. In all likelihood, it won't make it there at all. So what I'm saying is you would play this game across not just one stock, not just one time. This is a long-term bet where you're saying, I'm going to be working on making 1% more than everyone else on average per 5 months.
And this is why the market's so awesome, everybody, because there's different ways to attack it. My friend, Mr. Brandon, is going in one direction, and I go in a different one. And the point is, he's got a plan, and I have a plan. And
Jim's winning. For anyone that's keeping a score, Jim is winning hands down. I'm still refining my goals here, but yeah. I'm happy with how it's going so far.
It's okay. I just have there is a fundamental basic rule to never bet against yourself. And if you are buying a stock,
don't buy insurance. Like That is betting against yourself.
Well, so exactly. Well, even a call option is a form of insurance,
So like
depending
if you buy,
on
it is, yeah. So if you
what
like
you're
people that buy puts are betting against themselves if they own
and
this.
people yeah, and people that well, they're not betting against themselves. They're trying to protect their downside risk. It's a risk management
Sure.
uh, it's a risk management strategy for people that are long who don't want to incur taxable income and want to protect the stock on a downside window of risk.
Sure.
So that's
In a way, you
that's
could think of a selling a call kind of the same way. It doesn't have quite the same potential to swing way high and like really shield you, but it does a similar thing.
yeah. So the downside of the option selling is that you get a premium, but you can't compel someone to buy it. I'd
Right.
rather,
You get the premium and you lose control over your own stock.
in my world, I'd be looking if I was going to do anything on the option side of the window, because I don't need to own the stock at all. I'd be up here somewhere, saying, look, I'll pay a premium to own the stock at a leveraged value.
I assume you're
Uh,
thinking of a call of a put, buying a put down there.
buying an option. So like, let's say you're on this stock is selling for 147, right?
Or you're buying an in the money call.
Yeah,
Yeah.
yeah. I'll go up here because
That's
if,
you're
if
you're
I
betting
believe,
bearishly.
well, you want to make $140. So no, I'm not betting bearishly. I'm betting bullishly. I'm
Sorry,
saying that
I'm sorry. Yes,
the
I
stock's
said the wrong one.
147. You
Yeah.
think it's going to make it to 160? That's 15 points or 14. Let's call it 15 to make my life easy. I'm just going to go back up here to like 140.
You could buy one as deep in the money as you want to mitigate that risk. It doesn't matter, but you're going to be getting
Well,
that whole
no,
dollar gain.
it's not a mitigation risk. If I have $14,700, I'll go up here and buy 200 option calls in the money because I believe it's going to be $148 by January. So I'll get double the return, and and my premium cost. If I can find a spot in here where my premium cost is minimal, you know,
Yeah.
uh, right?
Yeah, no, that's a great way to play it if you're
So
betting foolishly. I said the wrong
here's
one the first time.
here's 120. That's 27 points that I have to pay $2.50 for. So I could make this trade on this stock, let's say,
Uh-huh.
and I can buy more than I could have bought down at the bottom. And so I can go in here and say, well, I'll buy this. I don't want to do that. I want to buy one.
That reminds me, I was thinking of buying some TQQQ calls next week. We need to come up with a different name for it. I can't keep saying QQ all the time.
So I could buy those two calls at for $29, and let's take a look. What's my potential? My break even is 149, right? $2 above us, right? But if it makes it to what's my maximum profit? It's infinite. So why wouldn't I want an infinite profit if I'm bullish on a stock? Why would I want to sell for some cash at $149 when I could have an infinite potential on a stock I believe is going to rise higher and only risk $2.50 of my capital to get there?
Well,
I mean, it would seem like,
you're playing with time decay for one thing.
well, time decay is only valuable when the decay is in your favor.
Well, that's what I'm saying. You're losing value if anytime you buy a stock, you're losing. Sorry, anytime you buy an option, time is working against you.
Well, we'll find out how this works out because we're going to play the game. That's what we're going to do.
Excellent.
All right. So where are we?
That's probably what we should call it for this week anyway. It's been a long episode. It's not that long. It's in our normal time range, if we're honest.
We didn't go to 50 minutes again, did we?
We're at 45.
Oh my God. No wonder no one listens to us.
Well, I keep hearing long form's the way to go. Maybe we're not going long enough, Jim. I think we might need to shoot for 2 to 3 hour episodes.
Oh my God. Well, then you need a producer, and then I would need more whiskey because I don't think my bottle will stay full that
No,
long.
I was gonna say the reason I'm now saying our episode is ending is because I just ran out of margarita. We're,
Oh,
I
like it.
can't continue without it.
All right, buddy. Talk to you later.
Great time. Take it easy.